Hi everyone, welcome to the first episode of Myth vs Market. You know those trading strategies we see online? Some of them look so simple, so perfect, right? Hats off to the creativity. But the big question is, are they really that good or just too good to be true? Today, we'll run one such strategy in our system, backtest it properly, and see what the real picture is. In today's episode, we are checking out the backtested results of Trader Telugu's short strangle with adjustments. Now, this isn't your usual short strangle where you just enter on a Thursday and wait till your next Thursday. Here, we are adding some automation and a few smart adjustments. And trust me, that changes the whole game. So, first, let's quickly look at what this strategy is all about. We'll go over the basic rules, the main settings we are using for today's backtest, and then the big question. Is this strategy another trading myth, or does it actually have the power to work in the real markets? Okay, so let's first talk about the entry rules. Basically, how we decide which strikes to sell and how we are entering into the trade. Nothing fancy, just some simple methods, and yeah, we'll also see one small trick to cut down the margin as well. So for this strategy, we are entering on a Thursday at 10 a.m. We have got 4 ways to pick the strike. 3 are dynamic and 1 is fixed. Dynamic ways to pick the strikes are like just use the last month's high and low. Market usually respects these levels. And option 2, check the recent support and resistance on the chart. That gives us more updated levels. And option 3, look at the option chain, and open interest tells you where most people are building their positions. So we can actually take strikes around those levels. On top of this, there is one fixed method that is very simple, no thinking, no analysis. Every time, just sell 115 rupees of CE and PE in Bank Nifty and 25 rupees of CE and PE in Nifty. That's it. And the last one small extra thing what we can do is bring down your margin a bit down. Just add a small hedge buys like 10 to 20 rupees in Bank Nifty and 3 to 5 rupees in Nifty. Optional but very helpful. Alright, so now let's talk about the exit rules. Basically, when to get out. Whether it's a profit or loss, honestly, this part is super important because knowing when to leave is exactly what actually saves us and also decides when we can jump back in. Our first rule is very simple. If both of our initial option premiums decay by 80%, we just exit the trade. The second rule is based on the profit. If Bank Nifty gives 4,000 rupees and Nifty gives 3,000 rupees, we book the profits and exit then and there. And remember, we don't just sit and wait till premium go to zero. That's just like asking for trouble. So we get out earlier so that once our rule is hit. Another thing is every Thursday morning, whatever the situation, even if you are making profits or loss, we exit all trades so that we can have a clean slate before all the expiry drama. And our stop loss rule also is very straightforward. If our strangle turns into straddle, meaning the strikes are very close or overlaps each other, we just take that straddle value. Then on top of that, add a 10% stop loss. For example, if a straddle is 500 rupees, then our stop loss is 550. Simple maths, no rocket science. So after all this, if you exit early because of any condition, no problem. We can re-enter into the market again with the near week expiry and continue from there. So for example, if you have taken the trade on a Thursday and you got a profit on Monday, so on Monday itself you can enter into a trade, but instead of picking the current week expiry, pick a next week expiry. So that is all about the exit criterias. So the last part is adjustments. Market never stays steady, right? So we need some rules for those times when one side premium starts getting too heavy. These rules basically keep the strategy flexible. The first rule is simple. If one side premium goes more than 50% compared to the other side, we just adjust it. How are we going to adjust it? Just close the weaker side and add a fresh option closer to the stronger side, usually somewhere around 80 to 95% of its value. Like suppose the call is at 150 rupees and your put is at 75 rupees, then we close the put and add a new put between 120 and 140 rupees. Easy fix. And also at the market close, if both sides are not balanced between that 80% range, again we have to do the adjustment. This helps us in managing the gap ups, gap downs, or even sideways moves. Imagine if we have a decent sideways market, we can capture a lot of profit because of this overnight decay. Let's now deep dive into the backtesting results. On the screen, what you see here is the performance of the strategy Simple Strangle without any adjustments. We simply entered the trade on a Thursday and held it till next Thursday. Naturally, the profits look quite small. But in reality, once you enter the market, it doesn't move in a straight line. It goes up, down, and even sometimes sideways too. So it's important to first understand what can happen in these situations and then see how adjustments can help us to manage and protect ourselves from market behavior. Before we move into the detailed results inside the application, let me quickly explain a few common parameters that we publish in every report. This will make it easier for you to understand the outcomes we are about to see. Total P&L. This is the total profit or loss generated by the strategy during the backtested period. Average P&L. This is the average profit or loss per trade across all entries. Gross gains. This is the total of all winning trades combined. Gross losses. This is the total of all losing trades combined. Win rate. This is the percentage of trades that ended in profit. Max drawdown. This is the maximum drop from a peak to the lowest point during the test of your capital. Max profit. This is the single highest profit from one trade. Max loss. This is the single largest loss from one trade. Winning streak. This is the maximum number of profitable trades in a row. Losing streak. This is the maximum number of losing trades in a row. Slippage. This is the difference between the expected entry or exit price and the actual execution price. Execution speed. This is how fast our backtest ran. It took almost 30 minutes to test 2 years of data, which is almost 10 milliseconds per market minute. Brokerage and charges. These are not included in this backtest here, since they vary depending on the broker and the lot size. We considered only one lot here. So if you scale up to 32 lots also, your P&L will scale, but your charges will differ. Here, you can see the profit and loss trend. There is a small upward move in the profits, but notice how frequently big dips keep pulling your capital into a negative territory. This clearly shows how risky the strategy becomes without adjustments. Ideally, the trend should look like a steady upward line with only smaller pullbacks. We also have an yearly performance report that breaks down profit or losses month by month. Along with this, we have added a heat map that highlights which days or weeks gave us profit and which ones led to losses. These visuals make it very easy to understand the behavior of the strategy at a glance, and they help in making a better decisions. Okay, so let's understand the actual risk here. If we just enter and exit blindly without any adjustments, the profits are small, but the losses can be really big. Take the April 3rd trade. We entered on 3rd April and exited on 9th April. That one single trade gave us a loss of more than 19,000. If that wasn't enough, the very next trade from 17th April to 24th April, we lost another 16,000. Let's verify what happened during April 3rd and April 9th. While we are in trade on April 7th, the market opened a gap down of almost more than 1100 points. When the market falls that much, right at the start, honestly, there's nothing a trader can do. Even though the market recovered later, the damage was already done. If you look at the minute by minute performance report, at one point during that week, that is on 7th April, our loss had actually touched around 31,000. That means 10 to 15% of your entire capital was gone in just one trade. Imagine putting your savings in and within days a big chunk disappears. That's the risk we are talking about. The second example is the trade from 17th April. That week, the market moved more than 570 points in a single day. And because we didn't have any adjustments for the positions, that move directly translated into 16,000 loss. So, what does this teach us? A strategy without adjustments is driving a car downhill without any brakes. It may look smooth at first, but the moment road turns, you are headed straight for the crash. And here's the crash means losing a big part of your capital in just 1 week. Now, let's switch to one of the best performing combinations. In this setup, we enter only on Thursdays at 10:10 am. Make adjustments whenever required and exit as soon as any of the exit conditions are met. With this approach, the strategy delivered more than 93,000 profit over last 2 years. But here's the catch. We also lost a lot in brokerage charges during the same period. The key takeaway is this. Our backtest was done with just one lot, so naturally the charges look very high compared to profits. But in real trading, if you are scaling up to 10 lots, the profits multiply nearly to 10 lakhs while the charges stay close to 1 lakh. That means your net profit is around 9 lakhs, which comes to almost 36% annual return. If you remember the earlier case, our maximum loss was around 19,000. But now, after applying the adjustments, the maximum loss dropped to 11,000. It may not be the same day, but the important point is our worst case loss is now only 5% of our capital. That means we have reduced the risk from 10 to 15% of our capital to just 5%. That's more than 50% reduction in risk. Now, you'll notice something interesting here. Our win rate has actually gone down from 74.5% earlier to around 58% now. But still, overall profitability has gone up a lot. Even the maximum drawdown, which was about 36,000 before, is now only 11,000. So, in most of the important parameters, we are in much better position with this adjustment approach. Now, let's look at the profit and loss trend. Doesn't it look great? It shows consistent profits. Yes, there are drawdowns here and there, but nothing major. It has its breaks, but overall trend is always upwards. In fact, 2025 so far has been a very good year for this particular strategy. Of course, most of the losses earlier came in September to November period, but apart from that, every single year has been profitable. If you see the max profit per trade, it was only around 3,400 since we usually exit near 3,000. The max loss was around 11,000, which is not a best risk to reward ratio. But remember, these differences mainly happen when the market opens with a sudden gap up or gap down. That's part of the game. Now let's compare this with our most lossy trades before adjustments. Earlier you saw those trades with 19,000 and 16,000 losses, right? With adjustments, those same days now gave us around 3,000 profit each. That's a huge improvement. Of course, we still had that one big loss of 11,000 rupees, but that was a rare case when the market moved very sharply up and down within a short time. Let me walk you through that adjustment sequence so you understand what went wrong. On Thursday, the market was neutral to positive. By the end of the day, at around 2:36, the market started falling, so we had to adjust. We exited at 25,350 CE and shifted down to 25,100 CE by booking around profit of 800 rupees. Just 20 minutes later at 2:57, the market reversed sharply. So we exited our 23,850 PE and moved upward to 24,150 PE. So originally we started with 25,350 CE and 23,850 PE, but by the end of the day we were holding 25,100 CE and 24,150 PE, both with small book profits. The next day, as market kept moving upward, we had to keep adjusting PE side. First to 24,400, then to 24,650, then to 24,950 PE. On 26, there was no adjustment needed as the market moved in sync with our position. But on 27, the market opened a little lower, then dropped 250 points quickly. Because of that, we had to adjust again with a 24,800 CE. At that point, our positions became 24,800 CE and 24,950 PE, meaning both of these strikes overlapped and basically formed a straddle, or even it overlapped the straddle. Once that happens, according to our rules, we have to exit the trade. That's where we book the loss of 11,000 rupees. If you see the graph, the loss happened because of the sharp and fast market moves. Sometimes market adjustments can't keep pace, and that's part of the trading risk. But here's the bigger picture. Across this entire strategy, most of the losses were very small. Many times around 3,000 rupees, a couple of times 4,500 rupees, one time 7,000 rupees, and just this one time 11,000 rupees in the last 2 years. On the other hand, many trades kept giving us a steady 3,000 rupees profits. That's why, even with a win rate of only 57%, the overall profitability was very strong. Alright, let's move on to the next set of parameters. This time, we used 85% adjustments. Now, what's the difference between compared to the previous Thursday entry method and this one? Earlier, we entered only on Thursdays. Even if the trade is closed on a Monday or Tuesday, we would just sit and wait until Thursday came again. But in this version, as soon as one trade is closed, we immediately enter the next trade. No waiting for Thursdays. If we exit on a Monday morning, next minute we are already in a new trade. But this time with a near week expiry. Now if you look at the profit and loss trend, it's almost same as the earlier one, but with a big difference. Here we just see one big dip in the entire timeline, and that dip is actually on the same dates we discussed earlier. The dates when the market opened with a gap down of 1100 points and also market moved more than 500 points in a single day. Something major must have happened in those market days, right? So maybe an event or some news. If you have any guesses, do let us know in the comment section below, because if we can avoid trading such weeks, we can reduce this kind of big risk. Now let's talk about the profitability. The overall profit and the heat map both look very healthy. And here's the best part. Our profits increase simply because of the way we entered the trades. In Thursday only method, we had 111 entries in total. But here, since we entered immediately after exiting, we almost got 137 entries. That's 26 more opportunities. And those extra trades gave us an additional 10% return on our capital. So in short, same strategy, but with smarter entries and adjustments, we ended up with more profits and more risk. So let's take this example a step further. Previously, we tested the strategy with adjustments at 90%. Now we are going to improve the original Trader Telugu strategy by adding a trailing stop loss. The rule is simple. Once we hit 3000, we start trailing by 1000 while making the adjustments at 85% of the lossy position. With this change, the results look even better. Profitability went up almost by 10% compared to what we saw earlier, while the win rate stayed the same. The charges and other factors remained almost same too. Basically, we managed to cut some losses, also increase the profits at the same time. Of course, these trailing stop loss limits can be fine tuned. You can play around with different percentages to find the most ideal numbers. If you'd like to see more such experiments and updates, do let us know in the comment section below. Now, coming to the profit and loss trend, it looks excellent. Very steady, consistent upward growth with a very few drawdowns. Exactly the kind of trend we would like to see in a sustainable strategy. So to conclude, these are the profits and win rates across multiple parameters. Here where it says Thursday entry, it means we enter only on a Thursdays, no matter when we exit the trade. And the other adjustments are like once we exit the trade, immediately we enter into the trade again. For example, adjusting the trades anywhere between 70% to 95% on the CE and PE sides when they go into losses. Even with trailing stop loss added, the key is to identify the ideal numbers that give the most consistent trend. Now just imagine how much effort it would take to test 2 full years of data across 13 different parameters like this. Luckily, we have automated it, so we can run these backtests quickly and accurately. We would love to take this strategy further and test even more variations. So do let us know in the comment section below what kind of parameters or adjustments you would like us to try out next. So that's all about the backtested result explanation and whatever the insights we saw from this backtested information. And just to highlight, this strategy is from Trader Telugu's short Strangle video. So I have given all the links in the description below. So please do check them out. And if you need more explanation, please watch those videos as well. So a couple of observations what we could identify, and I have placed them here. So the one thing is we noticed is the day you enter is really matters. Some days the strategy just works way better than the others. But yeah, it's not the only thing that decides profit, but don't only depend on that, and don't keep in mind that okay, because I entered on a Friday it might be like this or something like that. Don't fall into that trap. Any day we have done the backtest and we have a consolidated report of over 2 years. So try to build your strategy, or apply these numbers based on the outcomes what we saw. And adjustments, that's the big deal. If you change the percentages, that results also changes a lot. You can't just randomly pick a number and say yeah, this will work out. So it has to match the market. So we proved certain numbers worked historically a little better than others, but again it all depends on the market pace as well, right? So for manual traders, this gets even trickier. You don't have any automation or tech to support you in this particular area of adjustments, right? So you literally have to sit and watch the market and adapt the percentages. That takes practice. So before putting real money, better to try and practice more. And lastly, there's no such thing as a perfect setup. The right combo keeps changing with market behavior, right? So flexibility is really key here. All this content we are showing mainly to demonstrate our tool and its capabilities. With this website, even you can explore automation trading and find those hidden patterns and use them for your benefit. So keep supporting us. Thanks a lot for watching this first episode of Myth versus Market. If you felt this video is useful, just hit that like, share and subscribe buttons below. One small click from you saves hours of effort for us and keeps us motivated to bring you more such insights for you.